Good day, and welcome to this brief recap of our momentum focus and target fund of fund ranges. While not as strong as the first quarter in 2021, the global recovery continued building momentum in the second quarter, supported largely by developed markets where the vaccine rollout is progressing at a faster pace, unlocking economies and easing pandemic restrictions. At the same time, new waves of the infections driven by the Delta variant has dented some recoveries, particularly in emerging markets. Global growth for 2021 is expected to be as high as 6%, with the IMF, OECD and Federal Reserve all revisiting their forecasts materially upwards for the year. We do, however, expect growth to moderate to 4.5% in 2022. The favorable conditions for risky assets in quarter two led to developed market equities returning nearly 8% in US dollar terms, compared to 5.5% from emerging market equities. At the same time, global bonds managed just 1%, with rising global consumer price inflation pushing up nominal bond yields, hinting at the potential for an earlier tightening of monetary policy. The local currency strengthened by 3%, therefore somewhat offsetting returns in local currency terms. Local equities were flat for the quarter, with resources pulling back 5%, industrials ending flat, and financials gaining 7.5%. The standout sector this quarter was listed property, gaining 11% in value. This despite weaker fundamentals still plaguing this sector. Nominal bonds were up 6.9%, while inflation linkers gained 3%. Within our funds, we remain tactically positioned for the risk-on environment, and this has led to a continuation of the strong rally we've seen within our portfolio ranges. I'm pleased to say that all funds in both these ranges have offered exceptional absolute, real and peer relative returns over the past 5 consecutive quarters. This has been especially welcome given the challenging environment South African multi-asset class funds faced over the recent 5-year period. All the components within our funds, aside from global fixed income, have contributed to returns over the past year, with both our local and global equity blends delivering significant alpha or outperformance above their respective benchmarks. Given the strong recovery in markets over the past 15 months, the risk of short-term setbacks and increased volatility are rising. However, while returns may be harder to come by, we maintain the view that risky assets and risky asset classes should continue to benefit from the recovery in global growth, as long as the current supportive monetary and fiscal policy settings remain in place. Close attention will be paid to signals from central banks in terms of both rising interest rates and the tapering of monetary support. We maintain a healthy exposure to domestic and offshore equities, but as always, we remain well diversified from an asset class, strategy, and mandate perspective. Thank you for your time, and please stay safe.